Dear friends, welcome to the monthly commentary on markets. Volatility in markets continued during the month. Multiple factors have contributed to this volatility. It started with tactical shift in favor of China, post the expectation of a massive stimulus to support their economy, strengthening of US dollar and the spike in the bond yields in United States. Election of Donald Trump as president created further uncertainty with respect to policy actions. FII outflows from the emerging markets in general and India in particular. News flow in Adani Group stocks and a weak Q2 result season added another layer of volatility in the markets. Let us now delve into some of these aspects in more details, especially corporate earnings, impact of Trump presidency on Indian markets, and Adani Group stocks. Let us now start with corporate earnings. On the corporate earnings front, it has been a quarter of broad-based weakness. However, most of the misses were in commodity pack. Investment-driven businesses too were impacted by the slow pickup in activity. Government capital expenditure has been a key cornerstone for India's economic growth, creating jobs, boosting infrastructure, and crowding in private investments. However, so far, CapEx has witnessed a significant slowdown, both at the central and state levels, with general government CapEx contracting by 12.7% year-on-year in H1 of this fiscal year. 29% CAGR in government's CapEx between fiscal year 20 and 24 has been a major driver for Indian economy's sharp rebound post-COVID. However, we believe the CapEx should show an uptick from third quarter of this fiscal year, which will have multiplier effect on the economy. On the consumption side, demand conditions remain mixed, with steady uptick in rural demand given low base and normal monsoons. However, rising inflation is affecting demand in urban India, more so in metros and big cities. Hopes are high on demand improvement in festival and wedding season. In general, we expect improvement in urban demand as well, driven by transient nature of inflation and improvement in job scenario. Pharmaceutical companies continue to report stable demand environment in India and globally. We continue to see reduced profit growth divergence across business sizes. Operating profit growth of large cap, mid cap and small cap companies has been 9%, 9% and 7% respectively. We believe capital goods, infrastructure, EMS, hospitals, pharmaceutical, tourism, automobile, new energy, e-commerce, jewelry are good themes to play in this market. Let us now move on to the impact of Trump presidency on Indian markets. Clearly, predicting the future policy action is fraught with uncertainties. However, if the past playbook holds, then the effect on India of this win could be more indirect versus that of, say, Ukraine, China, Iran, Western Europe. The main impact on India potentially could emanate from impact of increased tariff on Indian businesses and also implication of higher inflation on currency. Let us now start with the impact of de-escalation or stability that Trump may bring about in the geopolitics. Trump's foreign policy has historically favored negotiations over prolonged military engagement. This approach can lead to de-escalation in Russia-Ukraine conflict. Also, stability in Middle East coupled with higher oil throughput in United States can lead to oil prices remaining under control or possibility of it going down. This should have a positive effect on crude importers. Also, higher tariffs on China, Mexico and Canada will likely disrupt global trade flows. This policy can accelerate China plus one theme, diverting manufacturing investments to countries like India and Vietnam. We believe China plus one, defense, IT, global capability centers, chemicals, pharmaceuticals are some of the segments where India is relatively better placed. Overall, we believe stable crude prices, dislocating supply chains, and lesser geopolitical conflicts should work to India's advantage if the past playbook continue. Having said this, we will have to continuously watch for the evolving changes that we may see in the environment. At ASK, we have investment in a few Adani Group companies in the portfolio. However, to clarify, we do not own any investment in the company potentially involved in the current investigation. The Adani Group of companies today stand among India's largest and fastest growing diversified business portfolios spanning transport, logistics, energy and utility, materials, metals, mining, and various B2C sectors. The companies that we own operate on a repeatable business model focused on annuities. The financial strength of the Adani Group remains solid, characterized by a strong and improved balance sheet and robust performance indicators. This table demonstrates how the group has maneuvered various shocks, including COVID, Hindenburg event, which has been the short seller event, and others in the recent past. As you can see from the table, over the last 5 years, Group has been able to increase its EBITDA at 27% CAGR, demonstrating consistent growth. This growth has been delivered by simultaneous reduction in net debt to EBITDA from 3.8x to 2.2. This demonstrates the solid execution prowess of the group and prudent debt management to strengthen the balance sheet. This, in our opinion, demonstrates group ability to deliver superior growth in the coming years. We believe that post the Hindenburg event, Adani Group has emerged stronger. Group companies and promoters have successfully raised a cumulative $6.7 billion so far to strengthen the liquidity profile and balance sheet for growth. Let us now look at what can be the potential impact of this event on the investments. Let us now focus on the primary impact. We believe it is likely none, as the company likely referred to in the indictment is not part of our portfolio. Secondary impact can be a temporary impact on the stock prices of all group companies. But we believe it's not going to be material impact on the business. Risk to the businesses of the group companies seems low. At worst, financing may get delayed or a bit expensive, but not materially. Consequently, we believe stock prices should bounce back. We have already started to see this. What can be the tertiary impact of this event? Some financiers to the group may also see a temporary impact. However, as the financing is asset-backed, lenders don't seem to be at risk. We continue to maintain our existing holdings as of now. However, we remain vigilant and will not hesitate to take appropriate actions as required. Overall, markets have taken a breather, driven by multiple factors that have been at play. As we move forward, we expect sequential improvement in the subsequent quarters on the back of good monsoon, controlled inflation, which should revive rural economy. We also expect pickup in government spending, which is currently lagging the budgeted run rate, leading to pickup in activity in the country and thereby the corporate performances. We expect improvement in consumption volume growth as we progresses. Overall, we believe returns from here on will be more narrower. Focus on quality will take a front seat. Our focus on high quality businesses that are delivering superior earnings compounding should start to differentiate versus others. That is it for this month. Thank you and happy investing.